So last week's big economic release was the June report of the Consumer Price Index, our monthly read on inflation. This report was, I would say, fairly benign, and on the top line came in pretty favorable, I would say, and a lot of investors were happy to see that the number was actually a bit softer than expected. In fact, it was the fifth month in a row where consumer prices, at least core, meaning if you strip out food and energy prices, came in below expectations. And that goes against what a lot of people were expecting, certainly with things like tariffs going on and the threat of higher prices. So far, we haven't seen it, at least on the whole. If you dig into this number a little bit more closely, though, you are starting to see some potential signs of inflationary pressures. So one area that I was focused on last week is what we call core goods, excluding autos. And so this is really just goods prices, those areas of the economy that are going to be more impacted by tariffs. You do see a lot more imports here. So we did actually start to see that this number came in at the highest level in a few years. So this is something that we do want to keep an eye on going forward. It does suggest some signs of inflationary pressure, really just to tell you a little bit more what is in this category. And it is a broad one. Because of that, I need to refer to my cheat sheet, but just some things that I wanted to point out here. So men's shirts and sweaters up 4.3% in price level on a month over month basis. That's a big move. That is not a year over year move. That is month over month. So that is something to keep an eye on. Floor and window coverings up 2.2% on a month over month basis. Again, that's a number that you would normally see on an annualized basis. That was just month over month. Another one I'll point to is laundry equipment and other appliances up around 2% month over month. So these are the things that we're watching. We want to continue to keep an eye on in moving ahead, because this could be some potential, finally, some signs of inflationary pressure on the economy as a result of tariffs and the uncertainty related to them. So for the Fed, the way that they're interpreting this is I think that even though that overall report was benign, there's enough there to concern them and keep them on the sidelines for a little bit. The next FOMC meeting is at the end of this month, very late July. I expect them to remain on hold. And I expect that posture to remain at least for some time. And this is not going to please President Trump or those within the administration who really want the Fed to get going here and start cutting rates. In fact, moving to the other topic I wanted to cover, last Wednesday, we saw that President Trump, there was actually news floating that President Trump was preparing to get rid of Fed Chair Jay Powell. And that really caused some havoc in the markets there on the initial reports. He eventually walked that back and suggested that wasn't actually something he was considering. But we know that things can change very, very quickly these days, and certainly within the administration. So it's something that we want to keep an eye on. And I think that there is still some pressure there on Jay Powell. His job is still under threat. He is still going to be challenged and second guessed with regards to what he's doing or not doing in his leadership role at the Fed. So for us, I'll just say very clearly, we do not want him to go away. His term as Fed chair is going to expire May next year anyway. So I think that President Trump would be better off just leaving him in place, announcing that eventual replacement or nominating that replacement in a few months' time. Usually you see the replacement nominated between 4 or 5 months before the next term actually begins. Even on the news last Wednesday, we saw that bond yields rose and short-term rates came down, long-term rates went up. And that is what we refer to as a yield curve steepener, something that we're not too surprised of, because if you're getting rid of someone who doesn't want to cut rates, potentially replacing them with someone who does want to cut rates, that brings short-term interest rates down on expectations of lower rates. And it moves long-term rates higher on the expectation that easier monetary policy would cause inflation. And the other impact that we would likely see is a falling dollar. And sure enough, we saw the dollar decline on these reports. We saw equity prices fall. And so we need to watch this very, very closely going forward. And to be clear, there are certain areas of the economy that would benefit from declining rates. The housing market is certainly one of them. that is struggling quite a bit. And then the other area is those lower income households. We've seen delinquencies move higher. We know that this is what we call a K-shaped economy, one that's where we discern between the haves and the have-nots. Those that aren't fortunate enough to see their net worth rise because they own real estate or because they own stocks are not doing quite as well in this economic backdrop. And so there certainly would be some positives, but the economic data so far has shown that the economy is in good shape. We've seen a lot of resilience. So it doesn't necessarily suggest the Fed needs to come in and rush to support the economy just yet, especially with inflation still being a big question mark here. In case anyone's wondering, President Trump is no different than any other president in the past. Every president has wanted lower interest rates. The Fed is independent for a reason, but we've certainly seen that President Trump is not unique in this way. I think it's perhaps maybe a little bit unique that he is doing this publicly, but his feelings and desire for lower interest rates is certainly not unique. There's a very famous example for those of us that follow it with Lyndon B. Johnson summoning then Fed Chair William Martin to his ranch in Texas and actually physically assaulting him and pushing him into a wall to get him to provide more accommodative monetary policy. So these things are done, just not in public view usually. So I think that is important to point out. But anyways, I'm going to leave it there for now. I do want to just mention the fact that I will be gone next week on vacation. I'll be back the following week. I'm sure that I'll have plenty to update you on when I do return. I'll look forward to doing that. Until then, please reach out to your financial advisor with any questions.